I'm going to test your bookkeeping knowledge with 20 multiple choice questions. Some of these might be easy, but a few will definitely catch you out. Hi, I'm James, you're watching Accounting Stuff, and today I've put together a bookkeeping basics quiz for you. You know how this works, grab your pen, play along, and don't forget to share your score at the end. This video is sponsored by QuickBooks Online. Question 1. Bookkeeping is the process of recording, sorting and storing transactions, preparing financial statements, calculating profit or loss, or managing bank accounts. The answer is A. Bookkeeping is the regular process of recording, sorting and storing a business's financial transactions. Question 2. When you're setting up a new business, why should you keep the business and personal accounts separate? Does it guarantee lower taxes? Remove the need to keep receipts? Does it make bookkeeping easier to automate, or does it ensure the records only reflect the business? It's D. Separating business and personal accounts makes things less confusing and helps you meet legal and tax requirements. Question 3. A business has around 10 transactions per month and wants a cheap, workable accounting system. What should it choose? Should it outsource its bookkeeping, set up an enterprise system, use a spreadsheet, or use no system at all? It's C. For a low volume of transactions, a spreadsheet can be an affordable starting option, even though it may require more manual work than accounting software. Question 4. A bookkeeping system is a loan used to fund the business, a marketing plan to attract customers, a methodical way to track and organize transactions, or a set of rules for calculating tax. It's C. A bookkeeping system is an organized method for recording and categorizing transactions. Question 5. Which record is commonly used in a single-entry bookkeeping system? Is it the general ledger, the cash book, the trial balance, or the balance sheet? The answer is B. Single-entry bookkeeping mainly tracks cash inflows and outflows using a cash book. Question 6. Which bookkeeping system uses debits and credits to record transactions? Is it double entry, single entry, cash only, or manual only? It's A. In double-entry bookkeeping, debits and credits are terms used to reflect each side of a transaction. Question 7. In bookkeeping, what is a bill? Is it a bank transfer, a tax refund, money received from a customer, or money owed to a supplier? It's D. A bill is a record of money that a business owes to a supplier. Before we jump into question 8, I want to quickly thank today's sponsor, QuickBooks Online. If you're still paying bills manually, you know how messy it can get. You're switching between your bank and your books, entering the same information twice, and trying to keep on top of due dates so that nothing slips through the cracks. Wouldn't it be easier if you could just schedule everything in advance and know it's taken care of? Well, my friend, that's exactly what QuickBooks Bill Pay does. It lets you create, manage, and pay your bills all inside QuickBooks Online. Just drag and drop an image of your bill, and QuickBooks will use AI to fill in the details for you. Then you can schedule the payment, and once it's done, it matches everything back to your books. The result is less admin, fewer errors, and more control over your cash flow. If you want to try out QuickBooks Bill Pay, check out the link in the description to get the latest discount. And thanks again to QuickBooks for supporting my work by sponsoring this video. Question 8. In double-entry bookkeeping, total debits must equal total credits because all transactions need to be recorded, the accounting equation must balance, bank reconciliations need to be completed, or profit needs to be calculated accurately. It's B. The accounting equation is the core principle of double-entry bookkeeping. It says that assets are equal to liabilities plus equity. If you'd like to learn more about this, you can grab yourself a free copy of my accounting equation cheat sheet. I'll drop a link to it in the description. Question 9. A business buys a computer for $1,000 and pays immediately from its bank account. How should it record the transaction? Should it debit cash, credit equipment, debit revenue, credit cash, debit equipment, credit cash, or debit tax expenses, credit revenue? It's C. The business now has a computer, so we debit equipment to increase it. And since the cash was paid out, we credit cash to decrease it. Question 10. In cash accounting, expenses are recorded when cash is paid out, when cash is received, when an invoice is sent, or when a bill is received. It's A. In cash accounting, transactions are recorded whenever cash changes hands. Question 11. A business invoices a customer on April 30th for $500. The customer pays on May 10th. Under cash accounting, when should the revenue be recognized? Is it never, split equally between April and May, in April, or in May? It's D. In cash accounting, revenue is recorded as cash is received, not when the invoice is sent. Question 12. A business receives an electricity bill for June on June 28th and pays it on July 15th. Under accrual accounting, when should the expense be recorded? Is it in June? Is it in July? Is it when the supplier follows up, or is it never? The answer is A. In accrual accounting, expenses are recorded as they are incurred, not when cash is paid out. Question 13. How are transactions formally recorded in bookkeeping? In bank statements, in journal entries, in financial reports, or in budgets? It's B. A journal entry is a record of a financial transaction in an accounting system. We usually attach supporting evidence like bills or receipts to back it up. Question 14. You can't find a receipt for a recent purchase. What should you do? Don't record it twice, get evidence and note it, or guess the amount. It's C. If a receipt is missing, you should still record the transaction, but support it with alternative evidence. This could include a bank statement, a supplier invoice, an email confirmation, or an online order record. It's a good idea to add a note explaining the expense and why the receipt is missing, so it can be justified for audit and tax purposes. Question 15. Which term describes an organized list of every account held in a business's general ledger? Is it an account chart, a summary of accounts, a chart of expenses, or a chart of accounts? It's D. Accounts in the chart of accounts are usually grouped by category. We have assets, liabilities, equity, revenue, and expenses. Question 16. A business pays $60 for an internet service. Which category should the internet costs be recorded under in a chart of accounts? Is it revenue, expenses, liabilities, or equity? It's B. Internet costs are recorded as an operating expense because they're a cost of running the business. Question 17. How long should bookkeeping records typically be kept for? Is it 1 year, 3 years, several years, or no time at all? It's C. In general, records should be kept for a minimum of 5 to 7 years for legal and tax purposes. This does vary by country, so make sure to check which rules apply to you. Question 18. Which term describes comparing the cash book to the bank statement to check for differences? Is it account balancing, statement matching, the cash flow statement, or the bank reconciliation? It's D. A bank reconciliation is the process of comparing a business's own cash book records with its bank statements to ensure that the balances match. Question 19. During a bank reconciliation, you find a $15 bank fee on the bank statement that isn't included in the cash book. What should you do? Should you deduct it in the cash book, delete it from the bank statement, adjust it next month, or ignore it? It's A. This is a classic example of an omission. The bank fee should be recorded in the cash book to match the bank statement. Question 20. What is the most effective way to budget for tax? Is it to use last year's tax amount, to wait until the payment is due, to make an estimate based on income, or to set aside what's left after expenses? It's C. It's also good practice to set aside a percentage of income as you earn it, so you have enough to cover your tax bill when it's due. And bonus question, if you record the same transaction twice by mistake, what should you do? Should you ignore it, delete it or reverse one entry, keep both and reconcile later, or record it again? It's B. You should delete or reverse one entry to remove the duplicate. Keeping both would overstate your balances and make your records inaccurate. How many did you get right? Let us know your score in the comments. If you'd like to give QuickBooks Bill Pay a go, click on the link in the description to get the latest discount. I've also left a link there to my free accounting equation cheat sheet, which you can download to get a solid handle on the basics. See you soon.